Hello, hello, hello. I gotta adjust my screen so I can actually see you guys. Okay, how is everyone? How is everyone? Not the most amazing results from PayPal, but it does paint us a good picture for how, a legacy player in the payment system is sort of doing. And Q1's never supposed to be super, super great comparatively to Q4, so it's hard to compare quarter over quarter numbers. But let's talk all about it. I need to know in the chat how everyone's doing. Tell me how your day was. Tell me how you're feeling. If you're holding PayPal or if you're just here to sort of see, um, you know, maybe a competitor, another fintech, or just my beautiful face. Either way, I'm happy that you guys are here. But we will jump in. I've also added a couple things to the, not to the stream, but to the overall production here. So I recently started using the Webull trading app, not to actually trade stock because I can't. I'm in Canada, but they still let you create an account and look at their their viewing thing, which is easy for me because a lot of people on YouTube use it, so the audience is used to it. And the only thing is my mouse isn't working. That's the only thing I'm having problems with. So I'm using just the laptop trackpad, which is terrible right now. And PayPal's playing their earnings call music. It's getting me all hyped up. And they've got a good system that allows me to change through the different. Oh, come on. What did I click? Okay. Let me see what we can see here. Boom. How is that? The framing should be oh so perfect. Wow. So yeah, my camera's not actually blocking anything. I just sort of created a gap here so then you guys can see everything else. Stock is down nearly 4% in the after hours. It happens. We'll talk about it. Let's jump in and look at some numbers. Hello from Germany. Well, I'm reading it here from Canada. It's a crazy world we live in. That sounded like it came off rude. I mean, it didn't mean to be rude, but I'm just saying, like, it's cool. We're not even close to each other. Okay. Am I even on the right thing here? These sheets get longer and longer, right? Okay. So, first things first, I'd like to bring up some charts that are easy to read. Where is it? Okay, total payment volume, probably to be expected, but it is lower than Q4. That is a holiday season. It happens. Willie, I did know you were actually from Hong Kong. Hello, good to see you. I also will have chat functions during the actual call. I'll be able to type the last couple times I wasn't able to, but I thought I'd spend a little extra time fixing it up for you guys. Okay, so this is a good slide as well because I think it tells you the overall path of PayPal. So the users who are using PayPal are loving PayPal and they're using it more and more and more. Okay, so I use PayPal from time to time. I don't use it as much as I'd actually like to. I love their their user interface and everything like this. It's a beautiful platform. I have zero problems using PayPal. I absolutely love it. But they don't give me nearly as many features as they would like the people that use it in the United States. That's a problem, right? So if for example I did have the savings accounts and an APY and an ability to have an actual physical PayPal card, which I know is funny that I want a physical card comparatively to just the app. But still, I like to have it. I've got a love for physical payment cards, so I want one myself. So once those actually start to roll out even more internationally than they already are, then maybe the active or the transactions per active account will actually go up. Sorry, let me remove that yellow. I was just filling in something for my own chart. But that being said, the actual amount of users on PayPal might actually be flattening out, or we've been sticking around this 430 million active accounts, which is great. I mean, 430 million accounts is unbelievable. But right after Q4, we're starting to see a dip down like before, which wasn't seen last year. It's not a cyclical thing or anything along these lines. It's just, you know, there's other alternatives now where people can use Apple Pay or Google Pay or one of these things, Shop Pay, and they might be getting to the customer before PayPal does. So we might also see an increase in expenses as well in sales and marketing to try to, collect those customers. Same thing on merchant accounts, by the way. It was 35 million for the last couple quarters. I'm pretty sure it's 35 million this quarter as well. Yeah, 35 million merchant accounts. That hasn't grown in a very long time. So, we don't know what the total addressable market is. Obviously, overall, the total market is actually growing, I think, by about 14 to 15%. If I'm correct, the actual digital banking space, people looking for digital wallets. So, PayPal will grow regardless in that space, as long as that they can keep their top position. But obviously, competition is ramping up. Okay, let me see what else we can find here. Oh, you know what? I could be proven so wrong. Sales and marketing as a non-transaction expense. Okay, so them trying to grow their actual business, it's actually it's dropping. So very, very good. So that could be a direct reason why their accounts aren't growing as well. But who's to say? Here was a nice beat for the quarter. We got $1.17 of non-GAAP EPS. That was very exciting. It was expected to be 111. So they actually did go from 111 to 117 as the surprise. Very, very exciting. Now, this is where it kind of is a little bit iffy. And I haven't actually read into why or where they're actually allocating this, because setting up for the stream, we'll definitely hear about it in the quarter, however, whenever the person is talking. So their free cash flow was $1 billion. It's still expected to be about $5 billion over the next, for the remainder of the year. But if you actually zoom out and look at every single quarter that PayPal has been putting out, that this is the lowest that they've seen it since Q3 of 2019. Okay, so all of the great cash flows and everything like this throughout the pandemic is now back at the lowest point since then. So this is probably a large reason for why the stock is actually down. I haven't read too deep, but we'll definitely hear about some of the concerns in the actual earnings call. And I'll tell you guys more after the call about why, what's happening with my spreadsheets, because holy guys, I've got some pretty great news. Building something really, really cool on my off time. It's why I haven't been posting so many videos. Probably won't be posting another video in a couple of weeks. Oops. But I'm, trying to make something really, really great for you guys. And that obviously takes a ton of time and effort. So focusing on that for now. Now, for capital allocation, and then we'll jump into the earnings call because it should be ready for now. I am listening to the music playing. Okay, so don't worry, we're not going to miss anything. Whenever it comes to capital allocation, they are still pouring a ton of money into share repurchases. I love this, right? The call is starting right now. But just know that your ownership in the company over time is getting larger and larger, even if you're not buying new shares. Let's jump into the call.
After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by 1 on your telephone keypad. If you would like to withdraw your question, please press star 1 again. Thank you. I would now like to introduce your host for today's call, Ms. Gabrielle Rabinovich, Senior Vice President and Acting CFO. Please go ahead.
Thank you, Sarah. Good afternoon, and thank you for joining us. Welcome to PayPal's earnings conference call for the first quarter of 2023. Joining me today on the call is Dan Schulman, our President and CEO. We're providing a slide presentation to accompany our commentary. This conference call is also being webcast, and both the presentation and call are available on our Investor Relations website. In discussing our company's performance, we'll refer to some non-GAAP measures. You can find the reconciliation of these non-GAAP measures to the most directly comparable GAAP measures in the presentation accompanying this conference call. We will make forward-looking statements that are based on our current expectations, forecasts, and assumptions, and involve risks and uncertainties. These statements include our guidance for the second quarter and full year 2023, our planning assumptions for 2023, and our comments related to anticipated foreign exchange rates, operating margin, and share repurchase activity. Our actual results may differ materially from these statements. You can find more information about risks, uncertainties, and other factors that could affect our results in the most recent annual report on Form 10-K and quarterly report on Form 10-Q filed with the SEC and available on our Investor Relations website. You should not place undue reliance on any forward-looking statements. All information in this presentation is as of today's date, May 8, 2023. We expressly disclaim any obligation to update this information. With that, let me turn the call over to Dan.
Thanks, Gabs, and thanks everyone for joining us today. We had a good start to the year with stronger than expected growth across our key financial metrics. And I'm particularly pleased to see the TPV from our branded checkout meaningfully accelerate to 6.5% growth FXN, up 200 basis points.
Check the date on that, by the way.
While our unbranded TPV growth also accelerated from Q4 to post year-over-year growth of 30% FXN. Even with this strong start, there remain many challenging issues to navigate as we look forward. Both the macroeconomic and geopolitical environments are complex and difficult to predict. In these times, the strong message I'm giving the PayPal team is to focus on the things we can control. We know that job number one is to invest and innovate to improve our value proposition to our merchants and consumers. Since we honed our strategic priorities last year, we have consistently executed and delivered against our roadmap, and this work is beginning to reflect in our results. Of course, we still have room to improve in multiple areas, but we are making large strides in upgrading our merchant and consumer experiences, which are both significantly strengthened from a year ago. We are focused on executing in the most cost-effective and efficient way possible. As you can tell from our non-transaction related OpEx performance, we are more than delivering against our plan. As encouraging as these early results are, I would point out that we are just at the beginning of a multi-year efficiency journey. For several years, we've been at the forefront of advanced forms of machine learning and AI to combat fraud and to implement our sophisticated risk management programs. With the new advances of generative AI, we will also be able to accelerate our productivity initiatives. We expect AI will enable us to meaningfully lower our costs for years to come. Furthermore, we believe that AI, combined with our unique scale and sets of data, will drive not only efficiencies, but will also drive a differentiated and unique set of value propositions for our merchants and consumers. So despite the fact that today's macro environment is difficult to forecast, we believe we are well positioned to deliver a strong year and enter next year poised to reap additional revenue streams from the investments we are making in our products, while continuing to drive efficiencies and reduce our overall cost structure. Let me now turn to our Q1 results. As I said, we were quite pleased with the quarter. Our revenues grew by 10.4% FXN to $7.04 billion in Q1, nearly 1.5 points better than our guidance. Consequently, We anticipate our full-year revenues to be stronger than we expected, with the back half of the year being roughly similar in growth to the front half. We processed $355 billion of TPV, an acceleration of nearly 300 basis points sequentially from Q4 to 12% FXN, driven by 5.8 billion transactions in the quarter. With our branded checkout growing by 6.5%, we believe we improved our global share of checkout and gained share in unbranded processing. We saw our monthly active base slightly increase in line with our expectations, while TPA grew by 13% year over year. Importantly, our core PayPal consumer transactions per user improved throughout the quarter, and in March was 400 basis points higher than in March of last year. In addition, we saw consistent improvement in the quality of new cohorts in Q1 versus last year. For instance, our March cohort of new accounts had 24% higher TPA and 40% higher ARPA than in March of last year. These results strongly reinforce our decision to focus our resources on engagement and driving high-value accounts. Driven by continued discipline and execution, our non-GAAP EPS for Q1 grew by 33% to $1.17, exceeding the high end of our guidance by 7 cents. As a result, we are increasing our non-GAAP EPS guidance for the year to $4.95, up 20%. Our three strategic priorities remain consistent: improve our core checkout proposition, grow our unbranded processing, and drive adoption of our digital wallets. We are making good and steady progress on each of these interrelated goals. I'd like to highlight our unbranded suite of services, including Braintree and our newest platform for SMBs and channel partners, PayPal Complete Payments. Within the highly fragmented processing ecosystem, our PSP offering across unbranded and other merchant services is growing faster than the market, and we are taking share. We believe that in an apples-to-apples comparison, our volumes in these areas are now roughly equal to that of Adyen and Stripe. There are 4 points I want to make regarding our unbranded momentum. First, unbranded processing is a strategic imperative for us. Enabling our merchants with our unbranded service helps ensure that we have a deep relationship with our most important merchants. It enables us to bring our latest and most technologically sophisticated checkout integration across PayPal and Venmo and our Buy Now, Pay Later service to our merchant base. Going forward, we will primarily focus on enabling unbranded processing and our latest branded checkout experiences through Braintree and PayPal Complete Payments. Based on our early observations, our share of branded checkout stabilizes or grows when our latest checkout integrations are in place. Second, we will continue to invest to help ensure our unbranded platforms are best in class, enabling our merchants to reduce fraud and increase their sales conversion rates. We will do this while providing a comprehensive orchestration layer that enables our merchants to have a single point of contact and integration in a multi-PSP environment. Our platform reliability is now amongst the best in class, and our integrated servicing capabilities are increasingly differentiated. Third, we are focused on substantially improving the margin structure of our unbranded business. Our PayPal Complete Payments platform opens a new $750 billion TAM in the small and mid-sized business market, with a significantly enhanced margin structure compared with our largest enterprise customers. Our Braintree and PayPal Complete Payments platforms are also expanding overseas, where we can drive higher margins. And we are adding value-added services to our platform, like risk as a service, full omni-channel capabilities, payouts, and FX as a service to both enhance functionality and add incremental margins. And finally, enabling merchants with our unbranded services will provide a constant stream of incremental data to feed our AI engines and fuel our next generation checkout platform. We believe no other company will be able to replicate the unique nature and scale of our data set. And in the future, our AI engines will use that data to drive differentiated capabilities to improve the entire checkout experience for our merchants. We anticipate that this combination of initiatives will enable our unbranded services to become a clear market leader, drive additional growth in our branded checkout, enable our next generation of checkout, and provide new sources of margin growth. And I would add that we continue to win and expand services with new marquee customers like Live Nation, Booking.com, and Adobe. Our focused efforts in improving our branded checkout are clearly making a difference in the market and in our results. Our product and engineering teams have driven substantial improvements in availability, latency, and passwordless login. We also expect that our in-app native checkout solution via our APIs and SDKs, along with the deployment of our PayPal Complete Payments platform to our largest channel partners, should begin to bear significant fruit in bringing our legacy base to our latest integrations. Buy now, pay later continues to provide meaningful value to both our consumers and merchants. Over 32 million consumers have used our buy now, pay later service since inception at nearly 3 million merchants. We are now one of the most popular buy now, pay later services in the world, with $6 billion of TPV in Q1, growing at 70% on a currency neutral basis. Consumers spend 30% more on our branded checkout when using buy now, pay later, and we believe we have amongst the highest authorization rates and lowest loss rates in the industry. Venmo continues to grow its revenues by double digits, and we were pleased to see its TPV accelerate 550 basis points from Q4 to $63 billion. We're continually working to improve the Venmo P2P experience. This quarter, we launched an easier, more intuitive way to split P2P payments across multiple people, and we also increased the add funds limit for Venmo to $10,000. We recently added the ability for Venmo customers to transfer crypto to other users and external wallets, bringing it on par with the experience on PayPal. Later this year, we will add the ability for a Venmo user to pay a PayPal user and vice versa, bringing more utility to both customer bases. We are currently piloting the upcoming launch of Venmo teen accounts, which have been requested by both parents and teens for some time. Our Amazon and Starbucks experiences continue to grow nicely, and we recently launched PayPal and Venmo with McDonald's and just signed a deal with Microsoft to launch both Pay with Venmo and Buy Now, Pay Later for Microsoft's Xbox Store. Finally, I'd like to briefly touch on the search for my successor. The board has formed a subcommittee, and we are working with a leading search firm. We have detailed sets of criteria and skill sets to assess both internal and external candidates. We still plan to announce my replacement before year-end, and the process is well underway. One of the most important criteria influencing my decision to retire was that I felt that PayPal was on the right path to emerge from this economic climate in not only strong financial health, but also as a clear market leader in payments. Our results this quarter are another solid proof point that we are on that path. I'd like to thank all of our employees for their hard work and excellent execution. We still have a lot to accomplish and prove, but our customers are responding to our efforts, and that is and will always be our North Star. And with that, I'll turn the call over to Gabs.
Thanks, Dan. I'd like to start off by thanking our customers, partners, and global team for helping us to deliver a great quarter. Our results demonstrate the relevance, diversification, and strength of our payments platform. We are reporting healthy volume and revenue growth. This solid top-line performance, in conjunction with strong expense management and efficiency gains, resulted in outstanding earnings growth. Notably, we accelerated our revenue and earnings growth on both a year-over-year and sequential basis. Relative to the first quarter targets we shared with you in February, both our revenue and EPS outperformed. The foundation we established last year for cost discipline and to realize productivity gains allowed us to expand operating margin and deliver profitable growth. Before discussing our outlook for the second quarter, I'd like to review our first quarter results. As Dan mentioned, revenue increased 10% on a currency-neutral basis and 9% at spot to $7.04 billion. This represents a 3-year revenue CAGR of 15% and 20% excluding eBay. Transaction revenue grew 6% to $6.4 billion, driven primarily by our unbranded processing volume. Other value-added services revenue grew 39% to $676 million, predominantly due to higher interest income on customer stored balances and, to a lesser extent, solid performance from consumer and merchant credit. In the first quarter, U.S. revenue grew 13%. International revenue grew 3% at spot and 7% on a currency-neutral basis, accelerating both year-over-year and sequentially. Transaction expense as a rate of TPV came in at 93 basis points, 5 basis points higher than Q1 last year. This increase was primarily driven by 30% growth in our unbranded processing volume. These volumes grew approximately 3 times faster than our overall TPV growth. As a result, transaction expense dollars grew 17%. Transaction loss as a rate of TPV was 8 basis points for the quarter, a 2 basis point improvement versus last year. Transaction loss dollars declined 7%. Our ongoing risk mitigation activities and our mix of volumes drove this improved performance. Credit losses were $142 million, or 4 basis points as a rate of TPV. We ended Q1 with $7.5 billion in net receivables, flat sequentially. Originations were primarily driven by the strength of our Buy Now, Pay Later franchise. As we have discussed, later this year we plan to externalize a significant portion of this portfolio, reducing our balance sheet exposure and securing a long-term partner to support sustainable and healthy growth. Our reserve coverage ratio increased sequentially to 7.8% in Q1 from 7.4%, reflecting growth in the consumer receivables portfolio and some deterioration in our PayPal business loans portfolio. Relative to Q1 2022, our reserve coverage ratio improved 50 basis points. Similar to the broader industry, overall we're seeing a normalization of our credit portfolio to pre-COVID delinquency levels. We continue to be pleased with the quality and diversification of our credit portfolio and are closely monitoring the macroeconomic environment while making appropriate adjustments to ensure we continue to perform within our internal risk appetite. Continuing the trend from 2022, growth of unbranded processing volumes outpaced growth in branded volume, resulting in slower transaction margin dollar growth. Volume-based expenses in the aggregate increased 17%, and transaction margin dollars grew 1% to $3.3 billion. Transaction margin declined to 47.1% from 50.9% in Q1 last year. While we do anticipate ongoing mix shift, we believe that this performance will improve as we execute against the strategies that Dan outlined to drive increased profitability across our unbranded processing volumes and accelerate growth of our branded franchise. Strong discipline across non-transaction related operating expenses more than offset the contraction in transaction margin. On a non-GAAP basis, non-transaction related operating expenses declined more than 12%, with reductions in sales and marketing, technology and development, and customer support and operations expenses contributing significant leverage. This expense performance resulted in 19% growth in non-GAAP operating income to $1.6 billion. This is the highest growth in operating income that we have experienced in 8 quarters. Non-GAAP operating margin reached 22.7%, expanding 201 basis points from the first quarter of 2022. In addition, we're pleased to be reporting $1.17 in non-GAAP earnings per share for Q1, representing 33% growth year over year. We continue to be in a very strong position from a balance sheet and liquidity perspective, ending the quarter with cash equivalents, and investments of $15.3 billion. During the quarter, we generated $1 billion in free cash flow. Cash taxes related to the intragroup transfer of intellectual property reduced operating cash flow by approximately $430 million. And in Q1, we allocated $1.4 billion to share repurchases. For the full year, we continue to expect to generate approximately $5 billion in free cash flow and to repurchase roughly $4 billion of our shares. I'd now like to discuss our guidance for the second quarter and update our outlook for the full year. For the second quarter, we expect revenue to grow approximately 7.5% to 8% on a currency-neutral basis and 6.5% to 7% at spot. In addition, we expect non-GAAP earnings per share to be in the range of $1.15 to $1.17, representing growth of approximately 25% at the midpoint of the range. For the full year, given our earnings outperformance in the first quarter, we are raising our outlook. We now expect non-GAAP earnings per share to grow 20% to approximately $4.95, an increase of 2 points of growth from the guidance we shared in February. At the start of the year, we indicated that our framework for 18% non-GAAP EPS growth in 2023 contemplated revenue growth coming in as low as mid-single digits. We also shared that our objective was to deliver revenue performance that exceeded this baseline. Our first quarter performance and the guidance for the second quarter are meaningful steps towards achieving this objective. As Dan indicated, assuming that current macro conditions continue, we now expect our back half revenue growth to be roughly in line with our performance in the first half of the year. Additionally, based on the expected contribution of unbranded processing volumes to our growth, we now expect at least 100 basis points of operating margin expansion in 2023. We are encouraged by our start to the year, and at the same time mindful that the environment remains dynamic. We're focused on execution and will be agile and responsive to how the macroeconomic environment is playing out. And we plan to continue to guide revenue 1 quarter at a time. To wrap up, we entered the year as a more focused business with strong fundamentals. We're off to a great start in 2023 and believe we're well positioned to deliver revenue and earnings growth, expand margins, and generate strong free cash flow. We're continuing to invest to accelerate our growth and capture the meaningful opportunity ahead of us. In addition, our expansive scale enables us to realize additional efficiencies and productivity gains. We believe our digital payments platform is unrivaled in breadth and depth, which creates a powerful competitive advantage for us. And we have conviction that our strategies to accelerate our branded checkout franchise, improve the margin profile of our unbranded processing platform, and strengthen our digital wallet will result in significant and enduring value creation for our shareholders. We look forward to continuing to share our progress with you. With that, I'll turn it over to the operator for questions. Sarah, please go ahead.
Thank you. At this time, I would like to remind everyone, in order to ask a question, press star, then the number 1 on your telephone keypad. We request that you limit yourself to 1 question, please.
That hum hopefully will stop when she mutes.
We'll pause for just a moment to compile the Q&A roster. Your first question comes from the line of Tien-Tsin Huang of JP Morgan. Please go ahead.
Hey, thanks a lot. Nice performance here on revenue. So I'll ask my one question there. Looks like Q1 clearly ahead, like you talked about. The second quarter revenue growth is in line with what we have in the model. It's 3 points lower than what was just reported here, and then you're calling for second half to be in line with the first half, which is better than what we modeled and better than what you guys talked about before. So my question is, how much of this change is macro related versus maybe some momentum with some of the new products and integrations that, Dan, you were talking about, as well as curious on share gains, if your thinking is different there. And we've been curious if you've seen any sort of benefit from flight to quality with all the stresses in the banking system. Some of our survey work suggests that. So love to hear your thoughts on all that if you don't mind. Thanks.
Sure. That was one question.
Yeah, I know it's a wordful. It's a lot, sorry.
Yeah. So let me start with that, and then Gabs can come in. First of all, obviously, we had a real strong start to the year. It was stronger than our expectations. Look, we just missed around 11% FX and revenue growth, at 10.4%. It's still 150 basis points better than our expectations on that. And I think what really pleased us on that is all parts of the business accelerated. You had TPV going up 300 basis points sequentially from Q4 to 12%. Branded grew by 200 basis points to 6.5% growth. Unbranded, just continues to fire on all cylinders at 30%. And even Venmo was up almost 600 basis points. And so, it's a good, strong start. And the other thing, that we didn't mention is our Net Promoter Score, which is kind of, how do our customers feel about us, is at a 5-year high this quarter. So obviously, a lot of things are going the way that we hoped they would be. I think, if you look at second quarter coming down, third quarter, and then fourth quarter, we're lapping some one-time events in Q2 and Q3 that put pressure of about 1 point to 1.5 points on our growth. Normalized, you'd have, Q2 off of those one-time things, growing, 8.5%, 9% or so. So that's kind of the normalized growth in the quarter. As we look out to the rest of the year in the back half, what's changed in our outlook? First of all, we're a third of the way through the year as opposed to just coming into the year. And, there are two things that we think are happening right now. First of all, our initiatives are taking hold in the market. There's no silver bullet on any one thing that comes in. These are a number of small things, whether it be improving latency, 40% in the last, year. Our goal is to improve it like 50% by the end of this year. Our availability being at an all-time high. We are pretty much at 5 nines almost all the time. We're fixing bugs all over. We're reducing friction. There are less calls coming into service. Unbranded, we put a lot of investment in that, and it is taking off. And we have very high expectations for what PPCP can do in the small and mid-sized market and with our channel partners as well. And we're seeing things like new cohort strength, as I mentioned in my remark, that are significantly higher than cohorts we've seen in quite some time. And so we know we still have a lot to go do there, but when you have scale like ours, and you start making small incremental improvements, it has a flywheel effect. And so we're pretty pleased with what we're seeing there. The other thing is, look, we came into the year with really muted expectations around global e-commerce growth. We thought it could be anywhere from like -2% to maybe +2%, call it flat in general. We saw that pick up in first quarter. And we think it could be low single digits, maybe as high as mid single digits. Clearly, consumers are turning more of their spend to e-commerce than I think many of us expected. And as long as we continue to see those trends, we think now, which is very different than what we thought coming in, that the back half growth is going to be equal to our front half growth. So it's a much improved outlook than we had before. Jackson, anything you add to that? No.
Thanks so much.
Yep, you betcha.
Your next question comes from the line of Lisa Ellis with MoffettNathanson. Please go ahead.
Terrific. Thanks for taking my question, and thanks for all the detail on the unbranded strategy. Just a couple of follow-up questions there, Dan, for you. One, can you elaborate a little bit on what's driving the 30% growth in unbranded TPV and how sustainable that is? Meaning, like, is it a couple of large clients that'll eventually lap, or is this, more broad-based growth? And then second, can you just talk a little bit more about PayPal Complete Payments competitive positioning down market, and where exactly you think that's going to win, and what how quickly that will ramp? Thank you.
Yeah. So Braintree continues to do extraordinarily well, and it's not just winning incremental clients, but we are growing, our share of the overall PSP volume and our largest clients as well. Look, we did expect Braintree, and we do expect Braintree to moderate its growth, lapping some big deals last year. But honestly, we're working on some big deals this year too, and we got a lot of momentum in Braintree, and I think its success it's differentiated. It's driven by an open architecture where we are perfectly willing to orchestrate transactions to third-party services and other PSPs. And, we've got integrated servicing. We've got our availability, I think now is amongst best in class. I think we've got the lowest loss rates, fraud, in the industry, some of the highest auth rates, maybe up to 390 basis points better than others. And we've got a number of great value-added services, that others have, but we're expanding too, whether they be APMs or vaulting or real-time card updaters or payouts. And we're adding more and more that are really valuable to clients and also are very high margin, like FX as a service. If you look at, Adyen's results and you see how much their profits come from FX as a service, you can see why we're eager to add that. On the PPCP side of it, there are obviously some benefits as you move into the small and mid-sized market. First of all, you obviously have a higher margin structure than you do with your large enterprises. And we clearly see that even in the PayPal button dynamics that we have. It's a really flexible, simple integration. It's fully featured as well. It's got all the APMs, including Apple Pay. It's got vaulting, IC++, real-time account updater. It's got all of our latest integrations in it. It's integrated with Zettle for omni-channel capabilities. And it also is targeted at channel partners. And that's a really important thing, and we're making some really good progress in our initial conversations with a lot of our major channel partners. If those channel partners are hosted, they run their services as a hosted service. Once we upgrade them to PPCP, our latest checkout integrations very quickly move into that merchant base that's part of those channel partners. And it's a way of moving our long tail of merchants onto our latest checkout integrations. We're now fully live with PPCP here in the U.S. We'll expand to EU and to Australia next quarter. And the other really important thing about our unbranded services, besides the fact that we've got a deep relationship with our most important clients, is they drive a ton of data into our machine learning and AI engines. It's why we have amongst the lowest loss rates in the industry, the lowest instances of fraud, the highest conversion rates. And so when I look at all of that together, it's why I really spent time calling out, why unbranded is a strategic imperative for us. People have asked us about our transaction margin, what's happening with that, looking at our growth of unbranded. To me, that is a high-class problem for us to have. We are winning in that market faster than we anticipated. We have a very well thought through strategy and set of actions to drive margin in that business. And we're very focused on making that happen. And we're seeing the beginnings of that already happening. So I appreciate the question, Lisa. I think it's a really important one.
Thank you.
You bet.
Your next question comes from the line of Darrin Peller with Wolfe Research. Please go ahead.
Hey, guys, thanks. Braintree growth and mix obviously were a factor on the take rate and margins, but if you could just help us understand the dynamics of margins in the second half. I know you're lowering margin guidance by 25 bips to 100 basis points, despite with obviously very strong expense management results. Maybe you could just help us understand how much of that is related to either the Braintree mix versus any other variables in the second half we have to keep in mind. And just as a quick add-on to that, when would we expect the strength of the Braintree volume we're seeing to actually translate to some higher margin offerings at a faster pace? Thanks again, guys.
Yeah, you bet. So I'll start. You're right. So we have some margin dynamics that are worth calling out as it relates to first half versus second half performance, specifically as it relates to operating margin. Our Q1 operating margin performance is very, very strong with about 200 basis points of operating margin expansion. In Q2, our expectation is actually that it would be ahead of that from an expansion standpoint. And so we're really delivering the vast majority of the margin expansion on the year from an operating margin standpoint in the first half of the year. The back half, we actually have some lapping dynamics and some nuances that will result in much more modest operating margin expansion for 2H overall. Within that, I would say it's worth highlighting that Q3, I'd expect to see some pressure on operating margin, maybe some slight pressure. And then in Q4, we'll see expansion again, but more modest expansion than you're seeing in the first half of the year. And really sort of what the drivers of that are, and Dan highlighted a few of them. We do have some lapping dynamics in the back half of the year. In Q3 specifically, there were some benefits on the TE side. We're also beginning to really lap the benefits from increased interest rates and the increased revenue that we earn on customer stored balances. That really starts in Q3, continues in Q4. So as we lap that, we don't expect to see as much operating margin expansion in the back half. In addition, we begin to really lap a lot of the cost savings work that started in the back half of last year. And so while we do expect to see meaningful declines in non-transaction related operating expenses in both Q3 and Q4. From a percentage decline standpoint, it will not be as great as what we're seeing in Q1 and Q2. And so all of that taken together will result in that differential between the first half and the back half op margin expansion. For the full year, again, we do expect to see at least 100 basis points of op margin expansion. That change that you called out between the 125 and at least 100, that is predominantly driven by the fact that when we're talking about our revenue being slightly ahead, a lot of the benefit that we're seeing is coming from the Braintree business and having a lot more visibility in that pipeline, and that contributing to our top line, but also having some margin impact. Dan, do you want to talk a little bit about the strategies in Unbranded?
Yeah, I think maybe I'll just like take a step back for a second. I mean, I think, look, our strategy on average and over time is to deliver, double-digit EPS growth year after year after year. And we've had a good track record in general of doing that. You know, we've got a well thought through strategy and a set of actions that's going to deliver increased transaction margin dollars along with OPEX reductions to make sure that we do that. You know, we've talked a lot about the initiatives that we're focused on, and we've been focused on the same thing for over a year now. It's drive branded checkout. That's our number one priority. You know, all of our initiatives are linked to that. It's our highest margin service. It's our bread and butter, and we're absolutely determined to have that be best in class. You know, we want to drive unbranded because of all the things I talked about in my remarks. It helps us on branded share of checkout. It helps us in our data collection and all of the things we can do with those unique sets of data. And unbranded will be a new source of margin generation for us without question. We are beginning to put those services already into place. Many of them will go into place by the fourth quarter, and I expect to see the majority of those things start to take effect in 2024. And then clearly, we're managing our OPEX extremely well. I mean, I can talk in more detail on that if anyone has a question on it, but we said we thought it would be negative high single digits this year. It's likely to be 10%, negative 10% plus. And, you know, if anybody thought costs were going to be going up, they'll go down again next year as well. I can talk more about that. But we've got a real set of initiatives and strategies focused on this. We're executing against it. I'm confident that we'll be able to deliver on what we set out to do.
That's really helpful, guys. Thank you both.
You bet.
Your next question comes from the line of Jason Kupferberg with Bank of America. Please go ahead.
Thanks, guys. Good to see the improved revenue outlook here. I actually wanted to switch over to the branded side of TPV growth. As you mentioned, you had a couple of points of acceleration there. Wanted to understand which countries or verticals or other drivers, you know, what was behind that? Would you attribute any material amount of the improvement to the rollout of advanced checkout? And then just any directional comments on how branded checkout TPV growth may trend during the balance of the year in support of the revenue outlook you talked about. Thanks.
Thanks for that, Jason. I think maybe I'll grab that one. So if I just take like a step back for a second, like we're the market leader in online checkout, right? We've got 35 million merchants who accept us. 80% of the top 1,500 online retailers in the U.S. accept us. There's no other digital wallet that comes close to that acceptance. You know, in general, our auth rates are about 600 basis points better than the industry average. That means every time 100 things that a consumer does to buy from a merchant, we approve 6 more of them. And, you know, we've got consumer trust and brand trust in that when a small or mid-sized merchant puts PayPal on their website, yet they see a 44% conversion lift by doing that. And so these are really strong advantages that we're going to leverage going forward. But obviously, there's a ton of stuff we can still do. Like we're optimizing presentment. We're making sure that our best-in-class integrations are out there, whether that come through our branded checkout, whether that come through, you know, the new SDKs and APIs that we have, whether that comes through PPCP going into channel partners. So, because we know when we have our best-in-class integrations, we either have stable share or growing share of checkout. You know, our availability, as I mentioned, is closing in on 5 nines. Our latency improved it by 40%. We'll improve it up to 50% better. Makes a giant difference in conversion rates. Our passwordless login improved by 10 full points last year. We intend to grow that again this year, whether that be through passkeys or tethered ID or forms of biometrics. Buy now, pay later. But we're taking share there, and we are intending to continue to take share there. You know, our auth rates are higher, we think, than anyone else's because we know the customers coming in. Over 90% of the customers coming in to buy now, pay later are already PayPal customers. It's why we think we also have the lowest loss rates. And we know, somebody mentioned flight to quality, that people are coming to PayPal and our buy now, pay later services. And we are targeting all of the largest merchants. We know when our competitors' contracts are up, and we are going after that business because we see a clear shift in market share as well as spend when we have buy now, pay later in our checkout flows. And
Strong
obviously,
statement.
you know, we're now full GA on our mobile checkout with our SDKs and APIs. And we are now beginning to experiment with the first generation of what we call AI-powered checkout, which looks at the full checkout experience, not just the PayPal checkout experience, but the full checkout experience for our merchants. So we have a lot of things underway in our branded checkout, but I will just say this, the team is executing extremely well here. When they say they're going to get something done, they do. They have a roadmap that they're consistently executing, and what they think will happen is happening in the market. And so I've got a lot of confidence that we'll continue to see branded share of checkout be strong. And we saw, by the way, in US, UK, Germany, France, Italy, Spain, most of the EU markets, Australia, an improvement in our share position. Of course, there's not one uniform measure of market share, but any way you look at it, when your branded share or your growth goes up sequentially by 200 basis points, that's a lot of momentum.
Thanks, Dan.
Yeah, you bet.
Your next question comes from the line of David Togut with Evercore ISI. Please go ahead.
Thank you. Good afternoon. How are you thinking about the opportunity for cost savings and OpEx reduction beyond 2023? And in particular, if you could, maybe weigh that against potential, transaction margin dynamics as well, to the extent those will continue next year based on the trend we saw in Q1.
Yeah, I'll start off and then Gabs can attack the last part of your question. First of all, obviously we had good solid progress against what we said we were going to do, negative 12% in Q1. I think our OpEx for the full year could decline as much as negative 10%, which is a bit higher than we expected. And as I said in my remarks, we're just beginning on this efficiency journey. I think you're going to see our costs continue to come down year over year over year. And this is not just about efficiencies, by the way. It's not about just cost reduction. This is about doing things better. I think, there's no question that AI is going to impact almost every function inside of PayPal, whether it be our front office, back office, marketing, legal, engineering, you name it. AI will have an impact and allow us to not just lower costs, but have higher performance and do things better. This is not about trade-offs. It's about doing both in there. The other thing that the teams are doing and doing extremely well is they're improving processes right now. They're removing friction. We've got a much simpler onboarding process, first transaction resolution. We're seeing better engagement as a result, fewer calls, as I mentioned, higher NPS. You're seeing that in our newest cohorts coming in with significantly higher TPA and ARPA. And so I think this is going to be a cost journey that will be on for a long time to come. And I think at the same time, we'll just be doing things better than we've ever been doing them before as well.
Yeah,
Understood. Yeah.
Oh, please go ahead, David.
Yeah, no, just the second piece of that as well, Dan, which is there an inflection point you see coming in terms of transaction margin dollar growth accelerating at some point later this year or in early 2024?
You want to take that, Gabby?
Yeah, so I really think about it as a multi-year journey that we're on to continue to transition the business and really drive more profitable volumes through the unbranded processing side, while at the same time accelerating the growth in branded. We're off to a really good start. Q1, we saw acceleration in the branded business. It was very broad-based in terms of what we were seeing, and we continue to see very strong growth on the unbranded side of the platform. Sequential acceleration in unbranded, given its size and scale, is very impressive. Given the base of business that we run, it will take some time to see what I would deem an inflection point in the overall sort of TM dynamics. I would say Q1, did have some nuances to it, which included about 130 basis points of impact just from normalizing our credit provisions. So that's not specifically related to unbranded branded mix. It really was sort of credit loss provisioning that impacted the TM rate as well. But to your point, as we move through the year, we do continue to expect to see a continuation of the TM dynamic that played out in Q1. There are some exciting trends that we're seeing in the business, however. So I'd say what we saw in cross-border in Q1 and the growth in that business is quite encouraging. It was the strongest quarter we had for cross-border really since Q4 of 2021. That, of course, has a higher yield to it overall. So as we start to see some of those pieces of the business pick up, that will also help. And then just from a TM standpoint, we did see some pressure as well in Q1 specifically on the unbranded side for PayPal. And this is not Braintree business. This is the transitioning of our unbranded processing on the PayPal side to PPCP has created some pressure in the quarter, which we don't expect to be sort of ongoing as we think about how we exit the year, given what our expectations are for PPCP. So we're continuing to be disciplined about the growth of the business. We do expect all these strategies to start to play out and start to help turn the overall TM profile, but I would expect it's going to take a number of quarters before we see what we would call an inflection point.
Thank you.
Sure.
Your next question comes from the line of James Faucette with Morgan Stanley. Please go ahead.
Hey, good afternoon, Dan, Gabrielle. Thanks a lot for time this afternoon. I wanted to follow up on one of the comments or topics you've mentioned quite a bit in this call, Dan, and that's around engagement. And I wonder if you can give some update. You've mentioned that there's been some improvement in engagement, but I wonder if you can give some update on those initiatives more specifically, how that's helping engagement and conversion, especially things like advanced checkout, et cetera, and what kind of lifts you're getting from that. And maybe give a little more detail of how we should think about the tie into some of the unbranded initiatives and if we think there can be further, at least improvement in those engagement levels or uptake by merchants, et cetera. Thanks.
Sure. So first of all, as I mentioned, we've got these three initiatives. They all tie together, and they all lead to driving more share and volume of branded checkout. So as we do more and more on our unbranded, we put out our latest integrations into the market. And when we put out our latest integrations in the market, we take away friction, we take away latency, and we see more engagement and a lot more checkout go through our latest integrations. But one of the initiatives that we haven't really spent time talking about is what we're doing on our digital wallets. So those are the three, right? Drive engagement and monthly active users and ARPA through our digital wallets, drive our checkout, drive our unbranded, and they're all linked together, and then keep a tight envelope on our cost structure. Those are the four things that we're focused on. In the wallet, we're making good, solid progress, whether that be on our Venmo wallet or on the PayPal side of it. Look, the PayPal app is already one of the largest commerce and payments apps in the world. It's used by about 55% of our base right now. That's up about 600 basis points year over year. And our app users are predominantly our monthly active users, and they're our power users. They've got 35% more ARPU. They've got 58% greater transactions per active on it. And their churn is at least 25% less than the rest of the base. And, you know, the thing that I'm really pleased to see what John Kim and his team are doing is that the velocity of experimentation in our wallets now is like nothing that we've seen in quite some time. We have constant champion challenger hypotheses going out, replacing, you know, challengers that have been overcome by the champion. And that just starts to lead to more and more engagement going through. As I mentioned on the consumer side, you know, we saw consumer transactions per user increase every single month in the quarter. In March, they were 400 basis points better than March a year ago. And the whole idea of the apps right now are three specific areas. One, you know, upfront pre-purchase, call that shopping, where it's really about discovery, saving, and rewards. We introduced rewards recently. We have over 6 million monthly active users in our rewards right now. Those that are using it have an increase in those 6 million of 45% in their transactions per active. I mean, these are huge numbers. We obviously need to go from 6 million to 10 million to 25 million, but that will happen over time. You know, then we have purchase, which is all about being the most flexible, easy way to purchase. Buy now, pay later really plays into that. And there, we're clearly taking share. We clearly intend to drive that. And then we have post-purchase, which is like things like, how do I track my packages? How do I get refunds easily? How do I put that right into my wallet? And there, I talked about this the last earnings call. You know, on package tracking, we're now 100% ramped in iOS. We do all the package scraping now off of Gmail. So in one place, you can see all of your PayPal purchases and non-PayPal purchases. So you can track all that in one place. And again, for those users that have started to do that, their app engagement is up 32% and their transactions are up 20%. And so all of these things, James, when you think about what we're doing on just being better in checkout, driving unbranded so that we can drive better integrations going forward, and what we're doing in the wallet, they all link together to really drive our MAUs, which are our most valuable customers by far and away, and they went up slightly in Q1. You know, they're like 20, 30 times more valuable than just an active user out there, and to drive, you know, transactions and ARPA. So this is a flywheel. As Gab said, it takes time to drive it, but a lot of the things we're seeing right now, the reason, you know, we are taking up our expectations for what we think our revenue growth will be, taking up kind of our EPS as well, is because we're seeing distinct improvements take place in the market.
That's awesome. Thanks for that, Dan.
Yeah, you bet. My pleasure.
We have time for one last question from the line of Brian Keane of Deutsche Bank. Please go ahead.
Hi, thanks for taking the question. I wanted to ask about credit. Are you managing the book any different on credit given the macro and exposure to BNPL and merchants, and just thinking about maybe the impact of provisions for credit losses for the rest of fiscal year 23, maybe as a result of managing the book any different? Thanks.
Yeah, you bet. Thanks, Brian. So you'll see in the Q, which will be filed tomorrow, we did increase the provisions on the PPBL portfolio, which is the PayPal Business Loans portfolio. Overall, that portfolio is about 17% of our overall receivables, so sort of a sliver of our overall book. We did widen our credit box in the middle of last year. We have seen some performance that was less strong than we would have liked. That is working its way through our system, and so we increased the provisions. We've already started to see an improvement overall. We tightened the box, and that's something that will just work its way through our systems. We'd expect delinquencies to worsen through Q2, peak in this quarter, and then improve throughout the remainder of the year based upon the origination strategy. But really, that piece of the book is a very small component of the overall portfolio, and I'd say more importantly, the area that we're really growing, where the originations are quite strong, continues to be the buy now, pay later portfolio, and there we've seen very broad-based strength. And so that's a really important part of our strategy. It supports the improved checkout performance in our business on the branded side, and we're excited about the continued growth of that business overall. We did mention in the prepared remarks that our expectation is to externalize part of that portfolio during this year and work with a partner to really provide sort of longer-term sustained support for growth in that portfolio. And so I'd say overall, we continue to be very pleased with our credit portfolio. We've seen very good performance across the book. We are seeing some normalization, which we expected to see as it relates to just sort of normalization post-COVID, and really getting back to what we historically seen in terms of performance. But in terms of reserve coverage, when we take a look at reserve coverage today versus when CECL started, which was the first quarter of 2020, we're actually a few hundred basis points better overall, and so the book itself continues to be quite healthy.
Got it. Thanks so much.
You bet.
All right. Well, I think we're at the top of the hour, so I just want to thank everybody for your great questions. Thank you for your time, and we look forward to speaking with all of you again soon. So thanks, everybody. Take care. Bye-bye.
Usually has a little speech at the end. I was looking forward to that, or else I would have dropped off the call a little bit earlier. Okay, so lots to cover. I'm actually going to be bringing a special guest on to talk about this as well. And we can cover a little bit about what was just talked about. I know a lot of people here necessarily don't even follow PayPal to begin with, so we'll even talk about sort of what their whole business does. If you guys were watching that and were listening to things like branded and unbranded checkouts, I'll give you guys a quick overview, and I'm going to have someone come on as well. Let's see what I can do here. Once again, I said I don't have my mouse ready, so I'm using the frickin' trackpad. It's terrible, but gotta do what I gotta do. Let me see how to get this thing going. All right. Let me send out a little message. They'll join on in this other box here. We can get this call started. Boom. Okay. So, as they're joining up, I'll just talk a little bit as well. Yeah, what did you guys all think? I mean, someone said in the comments that that members fell behind. Yes, that's definitely true. That's definitely the big reason why I think maybe the fear is in there, is that, you know what, every business is based off of how many customers they have. How much you monetize them from there, I mean, that's, that's great. But even if you're having a great business and all these people are having more transactions per active, that's awesome. But if you're dropping your actives, then, it kind of falls off the boat there. So that could be the situation. I think they lost 3 million out of the 432 million. Let's put it into perspective, or 435 down to 432 for this quarter. That was after a holiday season, but the absolute amount of transactions per person is going up. Now, why are they continuing to go up every single quarter? Well, that's pretty interesting because, like they said, they're adding new things to allow tracking, to allow you to do all your bills on PayPal. They're making it a full financial app So to keep people there longer. If you're there and you're tracking your packages, well, maybe next package that you get, you don't want to go track it just from the Shopify app or whatever. You also want to have it tracked on your PayPal app because that's where all your other packages are. So you start to consolidate a lot of your purchases on one app because it has more of what you're looking for. So, no reason why, or, no real, disbelief for why they're growing so much. Let me just double check why they're coming. So I also wanted to speak on before he gets here. Wait one sec. Okay. Actually, he's going to take just a little bit longer. Once you hear my phone ping, that's when you know. Okay. Sorry. So, another thing that I wanted to talk on is like, I'm starting an online website that will take payments, right? You can actually see the thing in the description right now. I think, I was originally wanting to post all my spreadsheets on there, and then there was a more demand than what I was actually expecting. So then I actually transferred it into, I'm going to make a full website and everything and chart it all out, make it look beautiful. Okay. So really, really going to put a lot of effort into it this month and, try to deploy it and then grow it from there. And, with a lot of help of the community and everything. So, but that being said, the reason why I'm bringing this up is because as I was going through and using the different apps that there were to actually create this, and I'm building it from scratch, like literally hosting and deploying it myself, not through Squarespace or anything like this. I use this company called Firebase. Okay. They actually help authenticate users and everything like this. And they can also help with finding companies to help you take payments. Stripe was all over that list. Okay. So Stripe is who we're going to take payments with and everything like this for this business. PayPal was nowhere to be seen. And because I'm a shareholder in PayPal and not a shareholder in Stripe, I would actually like to use PayPal. Now, because it is just simply, no JavaScript and all these things, like you can actually take PayPal as well. But if it's not integrated with the other apps, like they said, oh, well, we're increasing all our channels with our partner channels and everything like this. But Firebase is pretty large. Like they're one of the largest authentication platforms that there are for businesses, and you're not partnered with them. So that I found was a little bit weird because obviously I would love to have that integration. But isn't Stripe listing soon? There's rumors about it. There's rumors that maybe they missed their shot. Who knows? Okay. Bear with me here. Why are you sending this? He's sending me pictures instead of joining. Okay, let me see if he's here. Show on stream. Riley, how's it going?
Going pretty good. How are you doing?
Okay, bear with me here as I can't hear you through my headphones, which is weird. I don't want there to be any echo.
I'll let you know.
Sorry?
I'll let you know if I hear any echo.
I think there might be a little bit coming through, but whatever. I'll just turn you way down and hope that it doesn't pick up. Let me know if this is okay. So, I wanted to talk a little bit about PayPal because obviously it's a big player in the payment space. Some would say even maybe the biggest, right? I think they're integrated with over 80% of the top 1,500 websites or whatever that take payment. So the Fortune 500 plus, or I guess you would call them Fortune 1,500 at this point. But they take they have a payment button for 80% of those platforms. That's absolutely massive, right? If you even look at the next highest, which would be Apple Pay, which we always talk about, Riley, as being a large competitor for either SoFi or whatever, they don't even hold 10% of that list, which is crazy. So a very large gain, right? Now, I heard you in the chat, and I appreciate your $2 about my shirt. Let's get this bread, even though today was not a good day for bread. I lost some money. Stock is down over 5%, whatever. It's not a huge position.
Oh wow, PayPal went down right after earnings.
Sorry.
PayPal went down right after earnings. Is that what happened?
Yeah, yeah. Right whenever they released, PayPal went down. So for everyone in the audience that's listening, Riley's on the SoFi Weekly podcast. He covers a lot of SoFi and other players in the space. He's becoming a real fintech fanatic, but doesn't follow, or maybe not often, following PayPal. Now, I'm not here to pitch you PayPal, but I'm here to tell you sort of what they do. And I've got a little bit of time before I head out. So let's talk about it. PayPal, as you may know, by the way, has a couple different businesses under their belt. You know, like Venmo, for example, is PayPal as well. Massive competitor to Apple Pay or even Cash App. They hold PayPal, which is what they consider branded checkout. So whenever you have the PayPal button or whatever, which they're recreating, which you might have saw during the earnings call, they spoke about PayPal's complete. Wait, where is it? I'm on the wrong page here. Bear with me, buddy. Okay, I like to have my sources. Yeah, PayPal Complete Payments, or what they were calling PPCP, is sort of their new system that they're going to be using for branded checkout. Okay, so a huge suite of products for a developer, which is who, like, I'm now becoming their target audience, like a really, really small, micro business that's trying to develop and integrate with payments. And the problem, like I said right before you joined, is that Stripe was on that list for the businesses that I was dealing with. PayPal wasn't. On the other hand, PayPal Braintree, which is mainly just called Braintree, is their unbranded checkout. Okay. Their unbranded checkout is unbranded. So most of the time, whenever you're using it, you don't even know that you're using it. Okay. It would be, you're just in Uber, for example, making payments through your Uber app and thinking that Uber's doing these payments when really it's Braintree. So that is really the crazy part about PayPal right now, and what's dividing the stock a ton is the two businesses, okay, of PayPal as a branded checkout and then Braintree. Now, PayPal as a branded checkout, the margins that they take whenever that actually happens is massive, okay? Whereas Braintree is much, much lower because they're just doing certain components that the companies need that actually use them. So right now, because PayPal's branded checkout is growing at, I think, like, mid-teens, and Braintree is growing at like a 40% rate, that it is cannibalizing their own business in a way that their margins are dropping because they're growing a less profitable business even faster, right? But it's still them growing in the payment space. They are taking more market share in the payment space, but it's just, large enterprises are looking for non-branded solutions. They don't want PayPal all over their company. If you check out with, I don't know, GitHub or something, which is another one of their things, that's all they want to see. You just want to see GitHub on GitHub's website. You don't want to see, Braintree or PayPal pop up. But
so what you're saying is, like, the companies that are hiring these processors and gateways, they don't want their checkout website, the checkout page, to just be cluttered with all these fintech names.
Exactly.
And
But they
that's
still
why they're
want all
trying to
of
go for
the
Braintree.
Yeah, and they still want all of the integrations and tools and everything like this. And Braintree's name won't even pop up either. Like it's very just, it's for the Walmarts and the Targets and everything like this. So these companies just want their name, and their brand name alone is strong enough to still facilitate, these payments, even though it's not actually them doing it.
Oh yeah, because if I just start a store up, nobody's going to want to enter their credit card information because they don't trust my web page compared to, like, PayPal's button. That makes sense.
Well, see, that's the exact thing, right? Is like because I'm starting this thing right now, I do want a Stripe or a PayPal branded all over it. Like, hey guys, this is not me taking your credit card information. This is PayPal and Stripe. I don't even get access to this stuff, you know? So you get the, what do you call it? Like the safety net of their brand names whenever you're small. Whenever you're large, like Microsoft does not need your help. You know, people trust Microsoft. They don't want or need Stripe and PayPal and Adyen all over Microsoft's thing, which is actually funny because they are actually integrating with PayPal and Venmo, but they don't need it.
So in terms of Braintree and PayPal, they both kind of do the same thing, but one is just like the generic brand that's behind the scenes. Is that correct?
The best way that I can sort of describe it is similar to Shopify, but I don't think that's a company you follow either. But pretty much the customization on Braintree is significantly more. Like they will allow you to take components of their business rather than just the entire thing, which is just a product that Shopify has recently launched. But so pretty much the difference is that PayPal is more of a cut and dry, branded PayPal, I mean, is more of a cut and dry product, whereas, you know, Braintree is, okay, well, I need this part of the checking process, I need the payment hierarchy, I need, you know, all of these different features. So yeah.
I would assume like Braintree is more of like a white label company where they sell you the package and you do it yourself, whereas PayPal says come onto our network and you do it through us, and then we're going to charge you a little bit.
Exactly.
Okay.
So, but the interesting part though, and one of the largest benefits of Braintree versus, you know, Adyen or Stripe, which are the biggest names in the space, is that they like Adyen and Stripe don't want to use PayPal because then you're supporting a large competitor. So even whenever I'm integrating with Stripe, like I have the option to, you know, add Google Pay and Apple Pay and all of these things for people to check out with, but PayPal's not an option. Braintree, whenever you're actually checking out with them, they will allow PayPal because obviously it's supporting the parent company. So might as well. So they'll allow you the Google Pay, the Apple Pay, and PayPal.
So I do know Adyen, or ADYEN, is another gateway processor, which is like in the same area as Braintree and PayPal. So is there a situation where they do need PayPal services, but they would never use it, but they'll use Braintree?
As far as I know, Adyen, Stripe, and PayPal, or Adyen, Stripe, and Braintree, they do not need each other. They are direct competitors. It's Google asking Apple if they need help. You know.
Yeah.
They're running parallel. But that being said, they're going after different markets, charge different rates. So depending on people's specific services, like for example, Braintree, what's really, really interesting is they charge a very, very low percentage. Like, you know, Stripe very commonly takes 2.9% plus 30 cents. Okay. Braintree, on the other hand, takes 2.59%. So much less, but 49 cents per transaction. So think about it this way. If you're a large seller, you're selling, you know, autos, you're selling mattresses, you're selling big ticket items, Braintree will save you a ton of money because you'd rather spend the 19 cents per transaction. Oh, he got kicked off. Oh, he'll join back. But for the people listening, you know, you'd rather save, you know, the extra amount on the 19 cents per transaction if the $3,000 or $15,000 transaction is being saved, you know, 4% of the overall transaction. So you can save a lot by doing, you know, by picking one or the other. That's why people will really pick Stripe versus Adyen versus all these other ones. Sorry. Just got to send him the link maybe to get him back in. But okay, bear with me. I just have to resend him a link. Would Walmart prefer Stripe over Braintree? Yeah, I think they actually do use. They don't use Braintree, if I remember correctly. It actually, though, what's funny is I think a lot of Google products use. Okay, bear with me. I'll even try to find a Braintree customer list because I remember seeing one where it showed a lot of the large enterprises. So yeah, there's a couple different reasons why people would use one over the other. But a small ticket thing like a Walmart, for example, where your average transaction is pretty low, you might actually want to choose a Stripe so then you can save on the 30 cents per transaction rather than the 49. Either way, right? Like both businesses are printing money. But yeah. Okay. It seems like Riley actually can't get on. He's sending me a bunch of photos. I'm sending him links and it won't work, so I apologize. All good. Okay. We'll disconnect from Riley for a second there. Maybe I'll bring back up the yearly thing. I just have a little bit left to go. Another great thing. Okay, another great thing that I also wanted to show off is PayPal's Buy Now, Pay Later product. This is unbelievable. They're one of the largest players already, and they just launched it. And the greatest thing is that everyone either has a PayPal account. 432 million people have a PayPal account. 433, sorry. And the greatest part about this is that you either need PayPal on your browser or you need Honey, for example. Honey, the browser thing saves you all the coupons. That's also a PayPal product. If either one of these are downloaded and you're logged into Honey, for example, on your Chrome browser, and it's connected with your PayPal account, which most are, okay? You're shopping on Amazon, you're going to go get something new. It will automatically prompt you saying, hey, by the way, you can just split this up into 4 separate payments if you'd like, 0 interest charged. Okay, well, I would love to do that then because it holds no reason for me not to. Money in my pocket is better than money in yours. So if I can save on that, the amount and slowly break it down, the average person is going to go, okay, well, I see 0 risk to it. And the truth is there practically is to the user if you're going to pay it back. Now, the actual interest, there's no interest to be paid out to PayPal, which is great. The idea is that they save a ton of money because the average person pays back their buy now, pay later using an ACH payments, which is automatic clearinghouse payments. They have the lowest take rates. Okay, so whenever you're actually doing an ACH payment, the majority of the money gets kept with PayPal. So they actually found that not only do the people that use buy now, pay later also end up using PayPal for other things. They go, wow, this transaction is great, and I have to, service this through the PayPal app. Next time I go to shop, I might as well use the same app. Keep all the payments under one roof. So they get a sticky client once they actually use buy now, pay later. It's serviced instantly without even you knowing that it is an option, just because you had an app that you didn't even really remember that it was PayPal's app. It just gets served, it just pops up in your browser. I'm in Canada, so I haven't seen this before. So maybe you guys have a much more often you see this interaction happen more often. I went down to the States, just down into Florida to see family and these sorts of things. And the first time I went on Amazon, I went to go buy something, and this instant pop-up, and I went, wow, there's no hassle with that at all. One click checkout, done. Okay, then I have to service it all through my app. Perfect. Not only that, they get to keep a higher margin, and then people come back for more purchases. They are the fastest growing they're the fastest growing player in this buy now, pay later space, and they're growing. They're becoming like a top 3 name at this point behind like Affirm and Afterpay. It's unbelievable. No wonder other players like Apple and these sorts of things are following suit because they're also players with, Apple Pay, and so they can follow similar things. The great thing is that PayPal is a large innovator. one of the things that I thought was great is that a large reason why PayPal is a large innovator is the CEO that we have today, Dan Schulman. Dan Schulman's retiring at the end of the year, or so he says. They said he'll stay on longer if he has to. And obviously, he's a big believer in the company. He just recently, last month, bought another $2 million worth of this stock just in his own money. Okay? And it's down since he bought. But that being said, he was a large reason. I think he joined in 2015. The company's innovation strategy was super, super slow. They got bogged down for a lot of reasons. And Dan Schulman came in there and fixed it up. He created a strategy that would allow them to create and deploy new products much, much faster. And so you've seen a culture switch in PayPal's business where they're able to push products much, much faster than they were before. And what's interesting is that even in their non-transaction OpEx is that they're actually saving, which is a big surprise to me. I definitely wouldn't have thought that they were going to be saving so much. Total non-transaction OpEx is down 12%. So super, super exciting. Okay. But that being said, I did want to actually show off, there was another sheet here. Capital allocation. So if PayPal is able to hold their own, okay, able to, oh my gosh, there's so many things I want to touch on for PayPal in no time, because not only do I love their strategy for growth already, but then their capital allocation is unbelievable. Their strategic investments and them actually buying or acquiring businesses has been an insane track record. The company that they purchased for Braintree, they also created this small peer-to-peer app called Venmo. Okay, this was at the time, I think it was 2012, whenever they purchased this. The Venmo was a nothing burger. They were buying it for Braintree. Okay, and then so you end up getting this company that you wanted an unbranded checkout and build off of that. And Braintree was this amazing new technology that is scaling faster than PayPal, but also Venmo is also scaling at unbelievable rates, 40+%. So you ended up buying this company that if you didn't, it would have been a large competitor. And it's just an unbelievable acquisition strategy. After that, Honey was a massive success, and there's a bunch of them, and I can't even think of them right now. I'm blanking hard. I think. Anyway, I'll come back to it if it comes to me. But even with that strategy, aside from just acquiring amazing businesses that have improved their company dramatically, like the way eBay did for PayPal, what a godsend. But that being said, they are also taking, in this dark blue columns here, they're taking all this money that you're giving them and they're pouring it into a ton of repurchasing. These are annual from 2016 all the way till 2023, which is only the first quarter. So you're seeing what kind of impact only Q1 is already having. Practically the same level of share repurchases that they did in the entirety of 2019. Okay? And all this money, whenever it comes to share repurchasing, is they're buying the available, shares that are out to the public. So whenever that happens, your, percentage of the pie is actually increasing. It's technically a dividend. It's technically a payout to investors, but it's just not directly attributed to your back to your account. It's just, making your size of the pie larger, right? So that should in tune actually increase the price of the stock. However, obviously, as you can see, that people are more upset with PayPal on top of how much they've actually repurchased shares. So a large portion of this is like I said with Riley, it's their transaction margin is going down because of a couple reasons, but mainly because Braintree is just growing too quick and their actual take rate on that is lower. However, they're expecting to expand that even in their first. They're expecting to expand that as well. So they should actually be making more on Braintree as time goes on, which I find really, really interesting considering, competition is getting stronger. But yeah, just in my opinion, a lot of great things, a long-term play. This is not an explosive 10x over, over the course of a couple of years. But PayPal over the last 10 years, if I if I have my number correct, I think it's 10 years, has outperformed the S&P 500 every single year. Okay. So the way I look at it is, okay, would I still want to be in an industry for which, this company is still supposedly going to grow because I believe in digital. I believe in, cash going away. I believe in all these things because I'm young and I know what I do and I know what the peers do. So I believe that industry will grow. I believe that, Venmo is a large app amongst all the young people, and who's to benefit from that more than PayPal? No one. So yeah, it's more of a value play than what I usually cover on the channel, but we cannot stop looking at PayPal, not only for if you hold other fintech companies or something like this, but also if you're just investing in the company itself, following the industry. As you guys know, I'm becoming more of a fintech fanatic, and I do want to just plug out to you guys because I do appreciate you guys being here. But what I'm trying to build, which I'm going to be calling future charts or something along this line, I'm not 100% sure, but I'm going to try to help you guys visualize all this data that I chart out. So I've got pretty lengthy charts, and they're getting even bigger because now I'm focusing on actually, selling it, right? It's a one-time purchase. Once you have it, your membership will be good forever, and I'll continue to develop it as time goes on. And the price is only going to get more and more expensive as, I add people to it and have affiliates pay out and all these things, which regardless. Anyway, all I'm saying is I appreciate the people that have signed up already. There's a pre-sale discount down below. Once the thing actually goes live, the pre-sale discount goes away and you guys will have full access to it, but that price will go away. That's not going to stick around forever. So that's for the loyal people that believe. Appreciate you guys. And I'll probably be releasing a video showing me developing this and everything like that, showing it off. Maybe I'll look back into PayPal doing all the payouts, but I think it'll be Stripe. That's all I'm saying. I think Stripe will run all the payments and everything like this. And then, like I said, once you have the one-time payment, it's done. You have full access, and we're going to continue to roll out new stocks and show out everything. It's all data visualization. So you're able to see all this data, not just in these quarters or year over year, but from like the beginning of time since these companies have started, right? That's what I really, really love. Like hypercharts, but even a little bit more if anyone remembers hypercharts, but they were bought out. So that service is like not even available anymore. I want to do that, make it much cheaper. No, monthly or annual cost, one-time payment. Let me keep the lights on and then, have access to all that stuff, make for great DD. And then whoever's using it can showcase it or whatever. But yeah, I'll probably be making a video on the development of this as it goes on. But aside from that, I probably won't be posting many videos. I'll be doing the lives when I can because it's nice and easy, and I'm listening to these calls anyway, so I might as well do that with you guys. But aside from that, I'll be probably stopping making videos for the next month or so I can, or maybe a couple weeks. I don't know. I get bored. But I really, really want to focus in on this project and get something great for you guys. So I appreciate everyone that's supported it. Shulis, it's in the description. It's the future. I think I've changed the name. It was going to be Future Sheets, then it's Future Charts. I think right now with the pre-sale code, it's $100 flat fee. And then you have access forever and all time. And like I said, as it goes on, it's only going to get more expensive as I add more people. But the people who have already purchased don't need to repurchase. You have the membership, it's done. It's for all the people that wanted to lack and wait a couple months to see how it developed. Snooze, you lose. So what was I going to say? Yeah. So even though that direct payment link out to Stripe doesn't actually take you to the website right now because it's not out, I'm still going to be porting over all those emails and everything like that over and create accounts and mail them all out to you so you'll have access whenever it does go live. Anyway, regardless, appreciate all you guys. If you guys have any last minute questions, I'll answer those. But aside from that, that's everything from me. I appreciate it. Okay. Yeah, so the one-time payment is, I think it's set at $150 right now, one-time fee, but because it's a pre-sale and the thing hasn't launched, it's only $100. Yeah, because I'm building this thing from scratch, so there's so many payments. Like I have to, you know, it. This is something I'm learning while building this. Is like for all the storage, you have to pay for all of that, and then hosting it onto the internet, and then all the authentication of all the accounts. So emails and passwords, those just can't be stored legally anywhere. You need to have like an authenticator that can authenticate those account signups and everything like this, and then so Firebase is doing that, and Firebase takes their rate, and so yada yada yada, bunch of fun. But yeah, and then Stripe takes their cut, and yeah, it sucks. But I want to build something great. Like all my life, I just want to keep building something that's, I'm proud of, and Amit's been showing me the way, and I just think there's a great community here, and maybe I get Vadim involved as well, and say, hey man, like you need to create stuff for me too, and then I'll cut him a slice of it, and everything like this. Like the people who are really, really good at DD, I also want a part of this community as well. And then we can build out something, phenomenal. Anyway, doesn't look like there's any questions at all. So I really, really appreciate you guys. If you do have any questions, whether it's about, that, or when my next video will be, or what live stream to do next, just DM me on Twitter, follow me on Twitter, whatever. I answer mostly every single message, unless people are just being trolls. Anyway, thanks guys. Appreciate and love you so much.